In chapter six, we're going to be talking about the preparation of a bunch of different financial statements, and we're going to start with the statement of financial position, or as it's more commonly referred to, the balance sheet. So, for a company's balance sheet, we are going to list everything the company owns, owes, and what the company is worth, or in other words, its assets, liabilities, and equity. It's permanent accounts that have balances that accumulate over time, and the balance at any one given time represents how much of that particular thing the company has at that point in time. It carries from period to period to period because assets don't lose value just because a year ended, and that does not go away just because a certain period of time ended. These things are tied to very real, tangible concepts, and they stay on our books at all time, and they tell the company's true financial position. For our assets and liabilities, the big delineator here is to figure out what is current and what is non-current. And the key to it is 1 year. If something is current, if it's an asset, you expect to convert it to cash, use it, or consume it up in a period of a year or less. If it's going to take more than a year to do so, or more than one operating cycle, it's a non-current asset. For liabilities, if you expect to pay off all of the obligations that are due on that liability within 1 year, it's a current liability. If it's going to take you more than a year to pay off that debt, it's a long-term note that you borrowed on, or a mortgage, etc. It is a non-current liability. It's a piece of long-term debt. And it's important to put that in there because if you company says, "Hey, we're $5 million in debt," having $5 million in debt that you owe tomorrow is very different from $5 million in debt that you're spreading out payments on over the next 20 years. So you need to separate your assets and liabilities into time-based categories, if you will, to know what is your true financial position at any one given time. So current assets, things that you use within a normal operating cycle, like cash, like receivables that you're going to collect within the next year, like the inventory you sell, etc. But non-current assets are the things that are going to sit on your books for an extended period of time. And the big three categories for most large companies are their long-term investments. They will invest in the stock of other companies that sits on their books and they hold on to it for years and years and years. Or they buy government bonds that take 10 years to mature or whatever. Those are long-term investments. You won't convert those to cash or use them up within the next year. All of the things involved in the manufacturing process, all of the machines, the building they reside within, any vehicles that transport inventory to and from your facility, all of those things are your PP&E, your property, plant, and equipment. And you're going to use those for extended multi-year periods as well. In the course of business, you're going to want to protect the things that you sell, and you're going to do so through intangible assets like copyrights, patents, trademarks, etc. The term on those depends on what type of intangible it is, but they're definitely long periods of time. Trademarks are for 10 years, but you can renew them indefinitely. Patents have a period of time of 20 years. Copyrights is the life of the creator plus 75 years. All of those things are way more than a year before you stop getting a benefit from them. They're non-current assets. And then you'll get some oddball things on your books that are an asset to you. They're going to help you, be profitable and conduct business in the future, but they don't fit one of those other three classifications cleanly. And you refer to those as other assets. For liabilities, you separate your accounts on the balance sheet into what is a current liability. The amount you're going to pay on something within the next business cycle. Non-current liabilities, the principal obligation of your borrowing, which is not due within the next business cycle. And even within non-current liabilities, you can have different classifications that are broken down into what portion of it is bonds, what portion's mortgage, what portion's note, etc. But they all fall under that big grouping of non-current liabilities. And then the equity section, the value of your business, is going to show, in this case, where that value came from. Was it paid in by somebody else, like shareholders? That's contributed capital. Was it the result of profitable operations and you turning a profit in the past that you've been holding on to? That's retained earnings. Is the value of your business up from things that you've not yet realized? That would be your AOKI or your accumulated other comprehensive income, your unrealized holding gains, your unrealized translation adjustments, etc. Or is that value that's going in there, but it's not entitled to your stockholders? Instead, it goes to somebody else, which is a minority owner in one of your subdivisions, or they call it a non-controlling interest. But that is all of the different places where equity can come from. So breaking a balance sheet down instead of just saying assets, liabilities, and equity, bam, 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 gives people a better position. What are we working with? Well, what portion do we have to meet our current upcoming operations? What portion of our assets are long-term things that we're going to be able to use for year and year? For our debt, when's it becoming due? And for stockholders' equity, how are we getting money? Are we getting it from people just giving us money all over the place? Are we getting it because our company has been operating favorably and we're able to retain earnings? Is the value of the business from things that we've not yet realized, and it's not actually sitting on our books. We don't have it. It's just there in case we get it in the future. All these things will help people make a better, more informed decision about your company. So for our assets over here, current assets, as a reminder, things that are going to be utilized within the next year in the next operating cycle, which is typically 1 year. So all of the things that would go in there would be your receivables, inventory, cash, etc. One element that's you're going to see on books that might not be a concept you've come across so far is cash equivalents. It takes time after you produce your financials to get them into the hands of the people that are going to use it to make decisions. And there might be some things on your books that aren't necessarily cash, but will or could be converted to cash, very short-term investments by the time somebody actually reads that. And three of those things are commercial paper. And commercial paper is it's a bit of a confusing concept, but companies are allowed to lend money to other companies as long as the term is less than 75 days. And they don't have to do a bunch of fancy tax stuff with that is like an investment in the case. It's a short-term loan to another entity, but the max on it is 75 days, which means by the time if you have commercial paper, it's essentially a fancy notes receivable from another company. If you have that on your books and you at the time you're preparing it at the end of the fiscal year, by the time somebody actually uses it, it's more likely that you converted that to cash. So it is for that purpose a cash equivalent. Two other things that fall in there are money market funds. A lot of we'll go to the personal sector here. A lot of banks offer you the opportunity to put money into a money market fund instead of your savings account, which gives you a greater return. And at any point, you can pull that out of your money market fund and put it into your savings account willy-nilly. So it's reasonable to think that by the time somebody uses this information, those money market funds will have been liquidated and converted to cash. And U.S. Treasury bills, they come in very short terms as well. They might be converted to cash. So if you see the phrase cash and cash equivalents, it's the combined sum of not just the actual cash this company has in its bank account, but all of the items on there, very, very short-term investments, which will most likely be converted to cash by the time someone actually uses this information 3 months or less to maturity. Short-term investments, more than 3 months, but less than the next year, the last operating cycle. So if you've got a note from another company that is 9 months in duration, well, it's not a cash equivalent, but it's not a long-term investment either. You're going to convert it to cash for the next business year. You would report it as short-term investments. Another thing that goes in here as well is you can trade your investments whenever you wish. If I wanted to go buy stock today and put it in my portfolio, I could let it sit there for like 2 months and then sell it afterwards. If it's more likely than not that you are going to trade an investment by the time somebody uses your information, well, it's a trading investment and it should be reported in short-term investments, accounts receivable or trade receivables. Again, you expect to collect from the people that owe you money within the next year, or else there's some bum customers. That is a current asset. Inventory, also a current asset. We better hope that when we produce a piece of inventory that we're going to sell it within the next business year. If we don't, we got problems. So inventory is going to be reported in your current assets because it's something that you expect to convert into profitability, namely cash, within the next year. And then there are prepaid expenses. Insurance policy is always the easiest one to wrap your head around. Most insurance companies, you can, if you wish, pay a monthly rate and you pay once a month for the 12 months out of the year, but they give you an option that you can pay in a big chunk in advance for the whole entire year ahead. And the cost of that is usually only the cost of 10 months for the monthly rate. So by prepaying in advance your entire year's worth of insurance, you get it at, if you will, 12 tenths or 10 twelfths, excuse me, of the price that it would cost you if you made those monthly payments. Rent is a very similar situation. If you're renting a facility, your landlord might give you a discount on rent if you pay for a ton of months in advance. Like buy 5 months, get one free. I've seen that before for not-for-profits I book cut for. Prepaying your expenses usually results in you lowering your overall cost of operations, which is why companies do it. They are things that are going to help you be profitable within the next business year, as long as that amount of prepayment doesn't exceed 1 year, and therefore will be reported as current assets. For long-term investments, those are the investments in the debt and equity securities of other people, which means buying long-term U.S. bonds, that would be a debt investment. Buying the bonds of other corporations, that would be a debt investment. If you plan on holding on to those things, or it's going to be more than a year before they become mature, you have to report them as non-current assets. People will be concerned with your company's liquidity, your cash you have available to finance operations. Since you're not going to convert these investments into cash within the next year, you need to let the users of your information know that you don't expect to have that financing available to you within the upcoming business cycle. Equity securities, it's the same thing for another, if you invest in another company, if you plan on holding on to that stock for years and years and years and years, uh, you won't have it there as liquid funds to finance operations. You need to report that as long-term investments as well. And even in this case, companies will invest in things they don't expect to utilize. Land is one. Recently, and I'm recording this in 2025, a lot of companies have been buying up buildings, especially after the pandemic ended earlier this decade, when the real estate market had low rates and there's a lot of property that was available for sale. Companies, instead of investing in debt and equity of other entities, just bought buildings and they held them for speculation. Maybe they're going to use them in operations, but they're not right now. So they can't declare them as a building and as part of their PBE because they're not using that in any type of production. It would be a building held for speculation. So it's an investment. They could sell it in the future for a profit, or they could decide at some point in the future they are going to use it for their own operations. But since they're not right now, it would go into long-term investments. If they were going to use it right now, it would go in with all of the other property, plant, and equipment that they have that it gets used in production and the conduct of their day-to-day operations. So everything you can think of that is a physical, tangible asset that production companies use or are located on or operate within or any of that stuff would go here. Buildings, land, machinery, equipment, furniture, natural resources, etc. All of these get reported on your balance sheet as a piece of property, plant, and equipment. And GAAP requires us to carry them at their historical cost, what we paid for them originally, and then keep a separate contra account, if you will, that tracks the value of how much value they've lost since you put them into use. So the two of those offset from each other is the book value, where your books are saying that asset is reasonably worth today, but you have to re display for information not just what the book value is, but how you're arriving at it. What was it worth when you originally acquired it, and how much value is it lost since you put it into use? Intangibles, I talked about this a minute ago, but they can include things like trademarks, patents, copyrights, franchise fees, broadcast licenses, etc. They're not physical assets. They lack physical substance, but they definitely have economic value. If you develop a new technology that people are going to want, those patents are worth a fortune. When YouTube was sold to Alphabet, I don't know what the exact number is off the top of my head, but I guarantee you all the patents on YouTube was and the thing that it uses to make its algorithms and all of the way that it's structured to work are worth an absolute fortune at the time. And because now that it's been acquired by Alphabet, Alphabet has the entire right to be the only people that uses that specific set of technology, which provides great value. And people would want to know that they have that, and they would put it on their books as an intangible asset. It does lose value over time. For some of these intangibles, not all of them, but some intangibles will lose value over time. So just like your PP&E, you can't just report what their current value is. You have to say what the value was originally, and then if you elect to, you have to display what their accumulated amortization is. It's funny though, GAAP does allow you to report these at book value, but if you just disclose the book value, you need to put something in the notes that lets people know when these intangibles were established, how you've been reducing their value on your books, naming what amortization method you're using, and all in all, how long you've been decreasing the value of these intangibles for, up until the point in time when people are looking at this information to make a decision about your company. So for others, others are things that just don't fit cleanly into one of the other categories. And the big one on here is deferred tax assets. Accounting is a pain. GAAP requires timing that the IRS does not, which results in a situation sometimes where you can't recognize a revenue or expense according to GAAP, but the IRS will allow you to, which is weird because now you've got a GAAP income statement that's reporting a different number than your taxable income. And that results in a situation where the amount of tax that you're reporting you should pay on your income statement differs from the actual amount of tax that you will pay. And in practice, doing this long enough, you'll know the difference of it. And that difference is a deferred tax asset. If you are reporting more taxes on your income statement than you're going to actually end up paying, while you're overstating your taxes to users of your information. And you'll be able to recoup that at some point in time, theoretically. So you would list that as a deferred tax asset. Some companies have the most ungodly deferred tax assets on their books. I do believe Amazon has something insane like $700 million of deferred tax assets on their books right now. It's not the only thing that would go there, but it's the big one. But anything that doesn't meet the clean qualifications of something else, just throw it into other assets, long-term prepaid expenses. For whatever reason, if you paid your rent 25 years in advance, you can't report all of that as a prepaid expense under current assets because not all of it's going to get utilized in the next year. You would have a long-term portion of that prepaid expense. Well, that's an uncommon situation, and it's not really an investment, and it's definitely not PP&E. You don't have a good place to put it. You'd report it under other assets.